All right, good morning, everyone, and thanks for being here. So multi-strategy funds, and in particular multi-manager funds, recently they've garnered a lot of attention, focus, and discussion, and with that, asset flows. I mean, just looking at the mainstream press nowadays, if there's an article out there in the newspapers about hedge funds, inevitably it's about multi-managers, some of their growth and performance. Just to put some metrics around the asset flows to help kind of frame this conversation with our panelists, in 2022, along with macro, multi-strategy funds were the only category to record net inflows. And the growth of those multi-manager platforms is now far outpacing the rest of the hedge fund industry. A study from the team at Goldman Sachs estimates that between 2017 and 2022, multi-managers grew by a factor of 6 times the rest of the hedge fund industry. And the team at Jefferies estimates that those firms with $10 billion and more than doubled their aggregate AUM since 2018. And again, there's been great performance and great tailwinds there. So with this discussion, we're going to try and cover a lot of that and tie it back to the importance of, some of these folks up here on the stage, ultimately how that's shaping capital allocations and at large the hedge fund industry. So with the first question, a relatively easy question that I'm going to pitch up to you, Joe. What have you made of the growing popularity of multi-strats and platforms over the last few years? And then a follow-on question to that. Do we think there's a tipping point, or do we fear that there's a potential tipping point out there?
Well, I think that the popularity has been driven by increasing awareness amongst investors that they want to pay hedge fund fees on alpha and not on beta. And when you look at the multi-manager proposition, often the target is double-digit returns with low vol and a high Sharpe. And I think that is a compelling proposition to investors. And that's why it's gotten traction in the marketplace. To your second point, it's certainly getting more competitive. I think the competition's manifesting in 2 places. One is on the talent front, and second, on the ideas front with the crowding dynamic. And our firm has, we take differentiated strategies to try to address both of those topics. We try to fish in a different pond on talent and have a different strategy. And then with regard to the crowding of investments, that's something that we've always focused on and contemplated in our strategy.
Paul, I'll ask the same question to you. You all with Jain Global, relative newcomer or soon to be entrant to the marketplace with a multi-manager. You're out there marketing and building a business. How are you seeing the popularity around that approach? And how have you been finding that as it relates to the launch of the business?
Yeah, so I would analyze it on 2 fronts. One is as an investment strategy, and secondarily as a business strategy. And I think as an investment strategy, to echo the point, you can't evaluate and assess what you're doing if you don't measure what you're doing properly. And I think what the multi-managers do is measure better than others. And because you can measure, you then can really lean in and understand where you want to take risk because you're properly measuring risk. And I think that is a better investment strategy, and that's why people are drawn to it. And then I would say from a business strategy, you can take all of the discrete pieces that are inside of a multi-manager, and you could deploy that yourself and create your own business and have duplicative costs, or you could find a great multi-manager and say, I want to invest in both the strategy and the business and get the benefits of scale and the benefit of somebody else doing that together. And I think the 2 of them combined have appeal.
Yeah. Multi-strats, in its original form, they obviously offer a diverse pool of strategies. And James, I'm going to come to you with this next question, because at Davidson Kempner, you've built somewhat of a barbell between your private and public strategies, and again, furthermore, offering that diversified return stream. So how is that shaping some of your conversations with your institutional LPs as you look at that barbell?
Sure. So Davidson Kempner's been in the multi-strategy business for 40 years at this point, and I think we have a bit of a traditional approach that may be slightly different than the multi-manager approach that I think has become very popular. So we focus on really strategies that have a high barrier to entry, and oftentimes those strategies, we're probably best known for stress credit investing, don't necessarily create the capital efficiency that I think is required for both leverage purposes and netting purposes that work very well within the multi-manager construct. I'd say in addition to that, we really focus on providing clients unrestricted access to quarterly liquidity, and so our fund is never gated, and we continue to provide unrestricted access to quarterly liquidity in the multi-strategy funds. To diversify the platform further, as we saw the growth of private markets, we built a barbell approach, and we built a set of adjacent strategies to our core multi-strategy functions within corporate credit, commercial real estate, and structured products. So we do have a credit opportunities business that's more of a private equity style approach, and then we do have a asset-based finance private credit business. And what we've allowed our investment portfolio managers to do is, let's say in the commercial real estate space, they ultimately can identify security, whether it's in a REIT or whether it's in a bond of a company that's been dislocated, and buy that for our hedge funds on a liquid basis. They can aggregate and buy actual operating assets, which we've done in the self-storage space recently, or ultimately we can work with a public company on potentially a private loan, which we did actively in the 2020 time period, primarily in the hospitality space. And then we allow basically our LPs to get the benefit of what we see in the private markets in our multi-strategy fund in the sectors that we actually operate in. And then in addition to that, allow them to effectively mix and match a profile of risk return and liquidity options for underlying strategies. And that's been a successful model for us, both in terms of keeping to the core multi-strategy product that we've been in since 1983, and then a range of these other products that we've built over the subsequent 10 plus years.
And then, Mark, maybe the same question to you as head of Morgan Stanley Investment Management Group's alternatives practice. There's a range of different alternative asset classes that you can put your institutional LPs into. How are those conversations, tying back to this concept of diversification?
Yeah, that's so just to frame the conversation here. I oversee the broader hedge fund business within Morgan Stanley. I think as some of you know, we've focused a lot more of our attention on the multi-PM platform structure. And I think as I look at it and as we've built out our business and what people are interested in is and why they've gained such interest in the platform space, it's pretty simple. It's been the return profile that generally people want out of their hedge fund portfolios, namely low beta, low vol, and economically viable return. And so to us, being able to construct that with a range of different pieces, I think is important here. For me, in my journey in looking at the platform space, it's really been three major concepts, I think, that have driven kind of improved investment performance and diversification via the platform approach. One is control, right? So the underlying PMs, you're able to impose a significant degree of control over them, not only in terms of their curated universe, the factor exposures they wear, et cetera, et cetera. You also have the ability to enforce, right? You could terminate a PM at a moment's notice or force them to bring their book back in line. Both of those things are really important in terms of driving diversification because you have far more control over being able to drive low correlations amongst the PMs. The one final piece, and I think investors have appreciated this, has just been the efficiency point too. There's lots of wood to chop, quite honestly, from a fee efficiency perspective, not only in terms of fees paid out to underlying PMs and how you express that, but also how much fees you pay out to the hedge fund ecosystem and being able to optimize that as well.
Yeah, and just on that last point around kind of how capital's allocated, it's probably a good segue into this next question. And Paul, I'll start with you, but you referenced it there. Something that a multi-strategy can do is kind of package a diversified alpha-generating return stream versus individual alpha. Multi-managers in particular are doing that, and individual performers with high sharps and consistent returns, you're allocating capital on a very dynamic basis. How do you, and Joe, this is applicable to you, and I'll come to you next on this, but how do you think about that allocation of capital amongst your risk takers and PM teams?
So, for me, what we want to lead with, and I'm building the long-short business, we want to lead with company and sector expertise. So the model gets so much attention, and I think that if you lead with the model, then you're not grounded in the idea generation. And what we want to do is we want to lead with the company and sector expertise have great stock pickers that can distinguish between a company and a stock, and then overlay and embrace a risk model that can be weaponized to take those ideas and enhance the returns. And I think that some people choose, and there are PMs out there, there are analysts out there, some people choose to be very stock focused and they don't really know the underlying company. Some people choose to be very risk focused and don't really fully understand the stock or the security below them. What we're saying is we can do all three simultaneously, but by leading with company and sector expertise, we can help smooth out some of the other pieces. And so what I'm looking for in talent is someone that's trained as a classic expert who can pick stocks and who embraces risk. And that's how we're going to build this from the ground up.
And Joe, maybe same question to you at J Goldman. How are you thinking about that allocation of capital and again, diversifying beyond certain asset classes or security types?
Yeah, so I think that we take a slightly different approach than the mega multi-managers. We actually allocate capital to ideas as opposed to requiring our PMs to run a set amount of capital at all times. And the beauty of this model, in my opinion, is that it allocates capital to people's best ideas, and then we aggregate 40 different P&L sleeves, just taking their good stuff and not taking all the other extra junk that populates most multi-manager portfolios. And then on top of that, we wrap around a systematic center book strategy. And so I think that we drive much higher returns on a gross unlevered basis as a result of that methodology.
Mm-hmm. Now, another tool that one can use or mechanism for diversifying is through geographies. James, at Davidson Kempner, I think you all have been somewhat busy globalizing your footprint, and I'd love to just maybe understand the importance of that and how it's led to overall strategy diversification.
Sure. Maybe if I even take a step back in terms of our business, we tend to focus on high barrier to entry strategies, and the growth of the equity markets, which have been really kind of driven by a handful of names, which I think a lot of people in this room are aware of, has also created a big drive of focus in the multi-manager product. And then we've also seen a big focus on the private credit market growing. And so I think you guys have all seen the stats that a third of the S&P 500's in the top 10 names. If you juxtapose that in the corporate credit market, which is somewhat out of favor with the growth of private credit, the total number of names that have publicly tradable bonds has tripled in the last 10 years. So non-investment grade bonds or loans with at least $500 million. And so we see a huge opportunity in terms of potential dispersion, which really hasn't come since the 2008 credit crisis. But in order to do this well, I think the barrier to entry is very, very high, right? You need quite a big breadth of coverage of individual companies and models. There's a lot of talent and focus around subscriber churn at Netflix, for example. I think there's probably less focus on a range of individual companies with $500 million of bonds that make it dislocated. And so we do this both in terms of breadth and then depth of underwriting of corporate credits. And then we also have the size and scale and workout experience to create enforceability and accountability on these individual companies and issuers. And then we've done this, I'd say, on a global basis, which I'm happy to speak about as well. But I think really creating a broad model to coverage a wide range of credits that, frankly, I think have gotten less focus and attention with the growth of the public multi-manager business as well as private credit.
I want to come back to correlation because it's almost the enemy or the antithesis of diversification, and it can really disrupt that multi-strat or multi-manager model. Mark, with your product Riverview Omni, how do you all track and look at correlation and ultimately, try and create that non-correlated return stream?
Yeah, so first of all, to me, the name of the game in the multi-PM platform space is driving low correlation amongst PMs. If you can do so, you create a lot more active risk budget underneath the hood, and obviously it's imperative in turn, though, that you need those correlations to remain stable as well. Just as a first starting point in our minds, one of the first order ways you can keep correlations down is to minimize the overlap in the trading universe in which the PMs operate. Obviously, as platforms scale and they add additional PMs trading the same sector, at the margin, you potentially gain less of that diversification benefit because they're trading the same securities. The second order piece, though, and this is one where you see a real divergence amongst the platforms, is just a degree to which they look to push idiosyncratic risk as the core risk within the portfolio as a means to drive low correlations. We're very much on that camp. Our view is that the degree to which you can minimize factor exposures, don't go too crazy about it, but keep it at a contained level. Those are important drivers of correlation, and therefore, if they're minimized, you're in a better spot. I mean, very simply, if two PMs are net long the equity markets, they're obviously going to be correlated by virtue of that. And then you could take that logic one step further around style exposure, industry exposure, and the like. I think on this stability of correlations, I think it brings up probably the largest core risk of the platform space is this concept of platform deleveraging. There's a large footprint of people conducting activities that are not terribly dissimilar to one another. And you could well imagine if volatility picks up, or heaven forbid we're in a funding crisis, what that might mean in terms of how much turns of leverage need to come down, and therefore what it might feel in terms of one's own portfolio. I think a couple ways to just insulate that. One is, as a starting point, to not be employing too high a degree of leverage. Secondly is to have a portfolio that is reasonably liquid such that you can make adjustments to your gross exposures as well. And then finally, a little bit picking up what was talked about before, is just being cognizant of the crowding or lack thereof of your PM's portfolios. There's certain sectors that optically may offer a lot more opportunities, but they also drive a lot more and attract a lot more capital towards it and can be much more prone to crowding and deleveraging than others.
Yeah, and I do want to come back to that crowding concept and topic in my next question. But before I do, maybe the same question to you, Paul, regarding correlation and how you're kind of like looking at it, tracking it, avoiding it. At Jain, you're going to be running the fundamental equities business, but as I understand it, there are multiple different kind of business verticals helping that, tackle that.
Yeah, I think that this goes back to what I was saying before. If you lead with the risk model and then you have the risk model dictate where you want to be, then you're more likely to have higher correlations. But if you lead with the idea generation and then you use the risk model as a tool to manage volatility, and then therefore you have an expertise and a judgment, you then have the ability to have less correlated ideas. If all you're doing is tracking the same factors and optimizing around avoiding factors to be therefore funneled into and crowded into the same factors, your odds of correlation will increase. So you have to be careful about whether the model is something like, is this man plus machine, or is this like machine dictating what man does? And if the point here is that it's man plus machine and that we generate ideas based on our expertise, and then we use the model to manage volatility and manage risk and to understand the risks we're taking, then that's how you limit correlations. If you just use the model to drive your ideas, you're more than likely to get sucked into the higher correlation bets.
Mm-hmm. So I want to come back to crowding because I think it's very related to correlation, and the two effectively go hand in hand. Look, I think from a crowding perspective, let's just look at some stats. I think I read in a Barron's article recently that they estimate multi-manager or multi-strats, well, really multi-managers, they estimate the AUM there to be about 400 billion. Now, I don't know if that's on a levered basis, unlevered basis, but it's clearly a significant segment in the overall alternatives and hedge fund industry. So how is crowding as a factor becoming more and more prevalent in terms of how you're operating and again, trying to avoid it? That is something that many commentators and people in this audience will probably kind of like be looking at and considering as it affects the business model. So, Joe, maybe I could ask you as, from a multi-manager perspective, how you all are looking at it, and then James, I'll come to you as a kind of more traditional multi-strat.
Yeah, I mean,
crowding.
I found Paul's answer remarkable. I feel like you're describing our business in some respects. I think that we really approach crowding from two perspectives. One is the idea perspective, and one is the top-down perspective. On the idea level, the heart of our strategy is around developing variant perception. Variant perception is really two things. One is having a deep understanding of what's going on in business and doing deep fundamental research. But then I would say probably equally important to that is understanding what's priced into stocks. And so when I say what is priced into stocks, I'm talking about a few things. You obviously have, the true buy side expectation, but also importantly, and this is something we focus on for, the firm's been around for 37 years. It's probably been the focus for pretty much the whole time, which is what is the crowding around the stock? How is our competition positioned in the stock? And I think that we are actually excellent at understanding that second piece of variant perception, and we actually can oftentimes flip it around and use it as an opportunity to find really compelling setups. Now, from the top-down level, like everyone else, we have a factor model. In the factor model, there is hedge fund crowding as one of the factors that we disaggregate. The statistics show us and give us comfort that we are not in crowded positions.
And James, maybe from your perspective, more traditional multi-strat, but still crowding is a factor that you're all looking at.
Listen, we fundamentally, I think, built our business very differently. So we tend to be in these very high barrier entry strategies, which I mentioned before. And I agree with Paul's comment as it relates to the bottoms up and the fundamentals are critical as it relates to not having a model drive the outcome. We've also, you asked this question before, Barsam, about being global. We've been very focused effectively on being global to continue to find incremental sub-strategies where there's differentiation in the alpha streams that we can drive relative to staying in the same markets and larger cap names that are driving a disproportionate amount of the alpha in a small number of individual names, but a huge amount of obviously P&L generation. If I can give one example, last year one of our big winners, which actually got a good amount of attention, was in a company called Adani. And so if anyone remembers, in January of 2020 last year, 2023, Hindenburg put out a piece that alleged misconduct at the holding company. I think a number of hedge funds were actively short the holding company. We have a local investment office in Mumbai. Our team knew the capital structure very well. Adani actually has a number of assets, and they have a number of subsidiaries below the holding company. And a number of those subsidiaries have USD bonds, and they were ring-fenced, they were unlevered, and they had first lien security over ports, energy, materials, shipping assets. So one of our biggest winners last year was actually not trading in the holdco, where I think there was a good amount of activity based upon this Hindenburg report, but instead we bought up a substantial amount of bonds in a range of subsidiaries that all effectively recovered over the course of the year, and we subsequently, exited that position on a dislocation. And so I think, the crowding effects can actually create some good opportunities, but I think a lot of those may be realized kind of underneath the hood. It's one of the reasons I think we're quite excited about what's gone on generally in the corporate credit space. There's been higher quality sponsors taking software LBOs private, for example. A number of these are great businesses, but they have no more public equity, but they have publicly traded bonds or loans. And so it's a space that we're quite compelled in, and think ultimately by its model differentiates the crowding aspects that may exist in more public markets.
Great. Look, with the time remaining, it wouldn't be a discussion around multi-managers without me asking about talent and how that's shaping up in the industry, and more participants now, more and more platforms. How is that war for talent shaping up? And Paul and Joe, I'd love your perspectives on this. Paul, you're in the marketplace trying to launch this business and recruit. Joe, you guys are doing this, you have been actively doing this on a continued basis. Paul, maybe I'll start with you.
I think it's related to the crowding question, which is like if I were to give an analogy and say, right, like there were 10 seats at a table 20 years ago, and 1 seat was passive investors and 9 were active, and the characteristics of the 9 people were all very different. It was a diverse market. And over time, now there's 2 or 3 seats are passive and 7 are active, and 2 are Tiger style, and 3 are multi-manager style, and 1 is retail, and 1 is now active long only, right? Like the composition's changing because the share that's active versus passive is changing, and this is for equities specifically, and then the composition is changing within them. So then what you say to yourself is the talent pool that wants to sit in those chairs changed. And the answer is no, not dramatically. And so that means there's maybe 3 people fighting for the same person that might sit in one. So that means that you've got certain places where there's more capital than talent, and they're going to do unnatural things to get the talent to come to the money. And then there's going to be other people who have the right amount of talent, or the right amount of capital, or a sufficient amount of capital, where they're in balance between supply and demand, and then they can take the perspective. Like, my perspective is, the seat's too valuable to fill it with somebody who's not good. Whereas if you have more capital than talent, your perspective is, I can't afford to not have an empty seat, so I'll put someone in there, and if they're no good, I'll fire them quickly. That's not the world I'm going to live in. And so that's how I view it, through the the scarcity and supply and demand.
And Joe,
yeah. So as I mentioned before, I think our goal is to fish in a different pond. So, when I look at the mega multi-managers, I think that we're looking for a different target than them. For example, if someone's out there who's making $10 million of P&L per year with a great Sharp, but doesn't really like managing people, doesn't want to grow a team, that person could find a great home at JGNC and might not be very valuable to the mega multi-manager. So I think we're looking for a niche strategies, or a specific type of person, so that we avoid direct conflict with the mega multi-managers. And I would just say to everyone here, if you know anyone like who I just described, please send them our way.
All right. Well, no better way to end than that. So we're out of time here, so I want to thank our panelists. Thanks all for being here and sharing your perspectives, and thank you to the audience for listening.
Thank you, everyone.